Estee Lauder company stock is down about 42% year to date, and it is currently trading at about $146. In this video, I'm going to discuss whether this is a good entry point or not. For that, I will first go over the business model of Estee Lauder companies. Then I will move on to the numbers to show the reason why the stock is down significantly this year. And finally, I'll do a valuation to show the upside. Let's first look at Estee Lauder company's business model. Estee Lauder manufactures, markets, and sells skincare, makeup, fragrance, and hair care products worldwide. They own several brands like MAC, Bobbi Brown, Tom Ford Beauty, Smashbox, Erin, Tory Burch, etc. A lot of these are very famous brands that sell a lot of product worldwide. Almost 50% of Estee Lauder's revenue comes from their skincare products, and when you combine skincare and makeup, that contributes about 80% of their total revenue. So Estee Lauder is predominantly a skincare company or a skincare plus makeup company. Let's now move on to the numbers. As you can see on the screen, at $146, the market cap is about $52 billion. For the past 12 months, they made about $15.9 billion of revenue. In other words, their price to sales is just over 3, which is not expensive. When you look into the PE ratio, that's about 52.37, which is on the expensive side, but there's a reason why the PE is so high this year. When you look into the EPS, that's about $2.79 for the past 12 months. And look at the dividend. Dividend is $2.64. In other words, it's about 1.81% of the stock price. Whenever I look at the EPS and dividend too close, that tells me that that dividend is not safe unless the company increases its EPS significantly in the coming few quarters or even months. So why is the stock down almost 42% year to date? And for that, you have to look into the screen where I'm showing 3 different numbers. The first number is the revenue growth rate. For the past 12 months, their revenue growth rate decelerated by double digits, 10%, and that's a significant deceleration. Even when you look, the second number that contributed to the stock fall is the net income. A year ago, they made close to $2.4 billion of net income, and all of a sudden, this year, they're only showing $1 billion of net income. That's a significant drop, almost 60% drop in net income, and that did not sit well with the investors. And the number 3 is the EPS number. It was $6.55 a year ago, and their dividend was close to $2.7, right? So $6.55 of EPS is significantly higher than the dividend that they pay. So they have a lot of money left to reinvest in the business or even buy back the shares. But all of a sudden in 2023, they're only posting $2.79 of EPS. And out of that $2.79, almost $2.7 is going out as dividend. So they have no money left to buy back the stock or reinvest in the business. And that also spooked the investors because they don't think the dividend is safe anymore. Look at what has contributed to this revenue deceleration and EPS reduction. As you can see on the screen, almost 50% of their revenue is coming from skincare, and skincare revenue reduced by 17% year over year. That's a significant reduction. When you look into the makeup, that pretty much stayed flat, $4.5 billion. And a year ago, they made $4.6 billion. Even the fragrance stayed flat. Hair care stayed flat. So the biggest contributor for this revenue deceleration is their skincare business, which reduced by 17%. Now look on the right. Their operating income was $2.7 billion a year ago, and now it's about $1.2 billion. So that's almost $1.5 billion reduction in operating income. The problem with the retail business is that whenever there is deceleration in revenue, the operating costs will not go down significantly. It's not easy for the operating costs to be reduced by the company because they own a lot of retail stores and they own a lot of employees. So they still have to pay their mortgages, rents, and they have to still pay the employees. So it's not easy to reduce operating expenses quickly for this company because the sales might grow immediately in the next few quarters and they cannot cancel a lease and then open another lease, right? So overall, my point is for retail companies, it's not easy to reduce operating costs quickly. So their net income has to suffer if there is a revenue deceleration. What's causing this revenue deceleration? They're blaming it on challenges in Asia travel retail, and they're also saying that slower than anticipated recovery from the COVID-19 pandemic. So is there any hope? It seems like there is, because they're giving guidance for the fiscal 2024 in which they're saying that their revenue can increase between 5 to 7%. And they're also saying that the earnings per share outlook is improving. This year they reported $2.79, right? So next year they're saying they can get anywhere between $3.43 and $3.7. So let's quickly look at the balance sheet. They have close to $4 billion of cash and cash equivalents, but they have a long-term debt of about $7 billion. So I cannot give credit to this cash in hand. Before I move on to the valuation, I want to make it clear that this is not financial advice. I'm not qualified to give financial advice. I'm simply recording my thoughts about Estee Lauder companies. As usual, I'm going to provide two different cases, one with reasonable assumptions and the other one with great execution. In the reasonable assumptions case, as you can see on the screen, for fiscal 2023, they made close to $15.9 billion of revenue. In the coming year, they are guiding anywhere between 5 and 7% of growth rate. I'm assuming that they can grow 7% year over year for the next 5 years on an average. The demand has to come back. There will be recovery in China market, overall Asia market. So they own a lot of good brands, and skincare and makeup is a growing industry. So 7% in my opinion is reasonable. With that, they can make close to $21.5 billion of revenue in 2027. This company has gross margins north of 70%, but being a retail company, they have a lot of sales and marketing expense and a lot of other operating expenses. So their net margin would be in the teens. I'm assuming 13% net profit margin because their operating margins are close to high teens. So I can comfortably assume 13% net profit margin, with which they can make close to $2.8 billion of net income in 2027. For a company that's growing at the 7% range and has a 13% net profit margin, I can give a multiple of about 20. But since Estee Lauder has international presence, they have very valuable brands, I can pay a premium multiple of 25, with which this company would be worth about $70 billion in 2027. They currently have close to 361 million outstanding shares. They have to make a lot of profit, then pay the dividend and use the rest of the money to buy back shares. But at the moment, they're barely making enough earnings to just pay the dividend, right? So I'm assuming 2% buyback. They actually used to buy a lot of stock before when their EPS was significantly higher than the dividend, but I'm assuming that there will be recovery in their earnings and they can buy back 2% of their float year over year for the next 5 years, with which they will have 0.3 billion outstanding shares in 2027. When I divide the $70 billion of market cap with 300 million outstanding shares, I get a stock price of $213. Currently they're at $146, right? So that's about 46% gain in 5 years. Plus I get to collect close to 1.8% of annual dividends. So that adds another 10% roughly. So we're looking at a 56% gain roughly in the next 5 years, which is decent. It's going to beat the index. Now let's move on to the great execution case. I'm still keeping the 7% revenue growth rate because even before the pandemic and before 2020, they were barely growing in double digits, and they were also growing very slow in some years and then growing faster in other years. So overall, 7% I think is good even in the great execution case. So the revenue would be same. I'm changing the net profit to 15%. So I'm assuming that they will control their operating expenses, get more efficient, and get a higher net profit margin because they have close to 70% plus gross margins. So with that, they will make close to $3.23 billion of net income in 2027. I'm going to assign a premium multiple of 27.5, with which this company would be worth about $89 billion in 2027. I'm going to keep the number of outstanding shares the same. The assumptions are same. 2% buyback year over year for the next 5 years. The stock price in 2027 would be about $270. Currently they're at $146. So that represents 85% gain in 5 years plus almost 10% additional gain in terms of dividend. So this is very attractive, almost 95% plus gain if they can execute very well in the coming 5. In conclusion, I'm estimating close to 55% gain in the reasonable assumptions case and close to 95% gain in the great execution case. Either of these, in both these cases, if I buy at $146, I can beat the index, but I'm actually neutral. I'm not buying the stock personally, and I don't think it's a bad idea if someone buys the stock at $146. But personally, the risk reward is not too compelling for me because I personally do not like retail businesses where the growth rate is slow, the competition is very, very high, and the net margins are significantly lower. And in addition to that, retail business like Estee Lauder companies operating in is actually a cyclical industry. So because of all of this, I will not be investing in Estee Lauder companies. If it gets close to $100, it may not get there, but if it gets to $100, that will be a compelling case for me because that's my personal choice. But otherwise, overall, I'm neutral on this stock. Let me know your thoughts in the comments. Thank you so much for watching.